Okay, so you own a home. You pay your mortgage. You keep the lawn reasonably tidy. And once a year, without much thought, you renew your homeowner's insurance. It has always just been there in the background. A quiet, boring line item, a few $1,000s a year, to protect the biggest asset you own, from fire, wind, and whatever else. Sounds almost too simple to think about, almost insultingly routine, the kind of bill you pay without reading. And that is exactly the problem. Because in 2026, homeowners insurance in America has quietly stopped being a boring background expense and become one of the most volatile, most expensive, and in some places most unavailable financial products a homeowner has to secure. It is no longer a formality. In a growing number of American zip codes, it is the single biggest threat to whether you can keep your house at all. Here is what the numbers actually look like. According to data compiled by insurance industry analysts and state regulators, the average American homeowner's insurance premium has climbed by more than 30% cumulatively over the past several years, with some states seeing far steeper increases. In parts of Florida, average annual premiums have crossed $6,000, more than 4 times the national average of just a decade ago. In parts of California's wildfire-exposed foothills, some homeowners have seen premiums double or triple in a single renewal cycle, when they can get renewed at all. And that last phrase, when they can get renewed at all, is the part of this story that has genuinely changed the game. Multiple major national insurers have either fully withdrawn from writing new homeowner policies in high-risk states or dramatically scaled back the number of policies they're willing to carry. This is not a story about prices going up. It is a story about an entire financial product becoming structurally unstable in the exact places where climate risk is highest and growing fastest. So let's actually go inside and understand what home insurance actually is, because most people have never had to think about the mechanics until the renewal notice shocks them. A home insurance policy is, at its core, a risk pool. You pay a relatively small, predictable premium every year. The insurance company takes that premium, pools it together with premiums from thousands of other homeowners, and uses that combined pool to pay out the relatively small number of claims that occur in any given year: house fires, burst pipes, wind damage, theft. The entire system works because in a normal year, the vast majority of policyholders pay in and never file a claim, while a small minority experience a loss and get made whole. That only works, though, if the insurer can accurately predict, using decades of historical data, roughly how much total damage to expect across their entire pool of policyholders in a given year, and price premiums accordingly, with a margin for profit and reserves. The entire business model depends on the past being a reasonably reliable guide to the future, and that is precisely the assumption that has broken. Now, understand the specific forces stacking on top of each other to break that assumption, because it is never just one thing. The first is a dramatic escalation in the frequency and severity of catastrophic weather events. According to data from NOAA's National Centers for Environmental Information, the United States has experienced a sharp rise in the number of billion-dollar weather and climate disasters per year compared to previous decades. Hurricanes making landfall in areas that historically saw less severe storm activity, wildfires burning through regions and seasons that used to be considered lower risk, and severe convective storms, hail and tornado outbreaks, causing damage totals that didn't used to register as major events. Insurers do not price policies based on vibes. They price them based on modeled loss projections built from historical data, and when the actual losses start consistently exceeding what those models predicted, insurers either have to raise prices sharply to catch up, or in the most severe cases, decide the risk in a given area is no longer something they can profitably underwrite at any price a homeowner would actually pay. The second force is construction cost inflation, and this one gets far less attention than the weather headlines, but it compounds the problem significantly. Insurance payouts are not based on what a house is worth to sell. They are based on what it costs to rebuild it. Materials, lumber, roofing, concrete, and skilled construction labor have all seen substantial cost increases in recent years, driven by supply chain disruptions, tariffs on certain building materials, and persistent labor shortages in the construction trades. That means even in a year with zero increase in the actual frequency of disasters, the cost to fully rebuild a destroyed home has climbed significantly, which mechanically forces up the coverage amount and therefore the premium needed to properly insure that same house. Homeowners frequently discover this the hard way, insured for a rebuild cost calculated years earlier, only to find after a total loss that their coverage limit falls tens of thousands of dollars short of what actual reconstruction costs in the current environment. The third force is reinsurance, and this is the piece almost no homeowner has ever heard of, but it sits underneath the entire pricing structure. Insurance companies don't just absorb catastrophic risk themselves. They buy their own insurance, called reinsurance, from massive global reinsurance firms, spreading catastrophic risk further up the chain. When wildfires, hurricanes, and severe storms cause enormous global losses, reinsurance companies raise the prices they charge insurance companies for that backup coverage. Industry reporting has documented reinsurance rate increases in the double digits across multiple consecutive renewal cycles in recent years, particularly for property catastrophe coverage. Your home insurer is not simply marking up your premium because they feel like it. A meaningful share of what you pay is being driven by a global reinsurance market that has become dramatically more expensive to access, and that cost gets passed directly down to your renewal notice. If you're finding this breakdown useful, consider subscribing and dropping a like. It genuinely helps this kind of content reach more people, and there's a lot more of this coming. Here's the part of this story that has become the most consequential, and it is the one most homeowners don't fully grasp until they're personally affected: insurer withdrawal. When an insurance company determines that a particular state or region has become unprofitable to underwrite at scale, given the combination of catastrophic risk and regulatory limits on how much they're allowed to raise prices, they don't just raise premiums indefinitely. At a certain point, they simply stop writing new policies there, and in some cases, decline to renew existing ones. Multiple major insurers have significantly reduced their presence in California over wildfire risk, and in Florida over hurricane risk in recent years, citing an inability to price policies at a level that reflects true risk, while complying with state regulatory limits on rate increases. When that happens at scale, homeowners in affected areas are pushed toward two remaining options, and neither one is good. The first is the surplus lines market, insurers not backed by the same state guarantee funds as standard insurers, typically charging significantly higher premiums for comparable coverage. The second is state-backed insurers of last resort, programs like Florida's Citizens Property Insurance Corporation or California's FAIR Plan, created specifically to cover homeowners that the private market has refused. These programs were designed as small, temporary backstops. In both Florida and California, they have instead grown into some of the largest property insurers in their respective states, holding hundreds of billions of dollars in total insured exposure, a scale nobody originally designed them to carry, and a scale that raises serious questions about what happens if a single catastrophic event forces a state-backed insurer to pay out claims beyond what its reserves can cover. Now let's build the actual financial model, because the abstract version of this story undersells just how large these numbers get for an individual homeowner. Take a home in a moderate-risk coastal Florida county, insured for a rebuild value of $350,000. 5 years ago, a homeowner in this situation might have paid an annual premium in the range of $2,200 to $2,800 for standard coverage. Today, that same homeowner, same house, same rebuild value, is more likely paying somewhere between $5,500 and $7,500 annually, assuming they can find a private insurer willing to write the policy at all. If they've been pushed into Citizens, the state-backed insurer of last resort, the premium may be somewhat lower than the surplus market, but comes with reduced coverage flexibility and, critically, exposure to potential special assessments, Additional charges every policyholder in the state can be required to pay if Citizens itself runs short of reserves after a major hurricane season. That is a mortgage-sized expense that didn't exist in this homeowner's budget 5 years ago, roughly $3,000 to $5,000 in additional annual cost, for the exact same physical structure, driven entirely by how insurers now model catastrophic risk in that geography. Now overlay the mortgage mechanics onto this, because home insurance is not optional the way it might feel. If you have a mortgage, your lender requires continuous insurance coverage as a condition of the loan, because the house is their collateral. If your policy lapses, gets non-renewed, or you simply cannot find affordable coverage, most mortgage servicers will automatically place what's called force-placed insurance on the property, a policy the lender purchases on your behalf, at your expense, typically at a dramatically higher cost than standard coverage, often several times more expensive, and providing coverage that protects the lender's interest in the property far more than it protects you as the homeowner. This creates a brutal trap for homeowners in high-risk areas. Insurance becomes both more expensive and harder to obtain at exactly the moment when failing to have it risks losing the house entirely through a much costlier forced alternative. Let's talk about the volatility angle, because this is not a slow, gradual trend. It moves in sharp shocks tied to specific catastrophic events. After Hurricane Ian struck Florida in 2022, causing tens of billions of dollars in insured losses, multiple Florida-focused insurers became insolvent and were liquidated entirely, unable to cover the claims they owed. Homeowners who had policies with those failed insurers were left scrambling for new coverage in an already tightening market, often facing significantly higher premiums simply because their previous insurer no longer existed. A similar dynamic played out in California following major wildfire seasons, with several large insurers pausing new homeowner policy sales statewide in a single announcement, not gradually phasing out, but stopping entirely, overnight, for an entire state's worth of new business. The lesson from watching these events unfold is that home insurance markets in catastrophe-exposed states don't degrade smoothly. They tend to hold relatively stable for a period, then experience a sudden, sharp contraction immediately following a major loss event, leaving homeowners with very little warning before their options narrow dramatically. Here are the underestimated costs that rarely make it into the mainstream conversation about this topic. The first is the coverage gap problem. Even homeowners who successfully maintain a policy are increasingly finding that standard policies exclude or severely sublimit specific perils. Flood damage is virtually never covered under a standard homeowner's policy and must be purchased separately, often through the federal National Flood Insurance Program, and wind and hail coverage in hurricane-prone states increasingly comes with separate, high deductibles calculated as a percentage of the home's insured value rather than a flat dollar amount, meaning a homeowner with a $400,000 policy and a 2% hurricane deductible owes the first $8,000 of any hurricane-related damage entirely out of pocket before coverage kicks in at all. The second is the home value dampening effect. Research from real estate economists has begun documenting that homes in areas with rapidly escalating insurance costs and shrinking insurer availability are experiencing measurably slower price appreciation and in some cases outright price declines compared to similar homes in lower-risk areas. Because insurance cost is increasingly factored directly into what buyers are willing to pay and increasingly factored into what mortgage lenders are willing to approve. The third is the underinsurance trap, where homeowners, trying to manage rising premiums, quietly reduce their coverage limits or raise their deductibles to keep the annual cost manageable, only to discover after an actual loss that they are tens of thousands of dollars short of what a full rebuild actually requires, a decision that felt like reasonable budget management in a calm year and becomes a financial catastrophe in a bad one. There's a real case study that illustrates exactly how this plays out at the state level. Louisiana experienced one of the most severe insurance market contractions in the country following a string of major hurricanes, with more than a dozen property insurers becoming insolvent or voluntarily leaving the state within a few years, leaving tens of thousands of homeowners scrambling for coverage in an increasingly thin private market. In response, the state legislature and insurance regulators implemented a series of incentive programs, subsidies and grants, encouraging new and existing insurers to write more policies in the state, alongside grant programs helping homeowners fortify their roofs against wind damage in exchange for mandated premium discounts. The results have been genuinely mixed, some stabilization in insurer participation, but premiums remaining well above historical norms, and a state-backed insurer of last resort still carrying a substantial share of the market that regulators originally intended to be served entirely by private companies. Louisiana is a live example of just how difficult it is to fully reverse an insurance market contraction once it has set in, even with direct government intervention. Let's be precise about what separates a homeowner who navigates this environment successfully from one who gets blindsided by it. The ones who manage it well shop their policy every single renewal rather than auto-renewing out of habit, because the pricing gap between insurers for an identical property can now be substantial enough to represent thousands of dollars a year. They invest proactively in mitigation, impact-resistant roofing, storm shutters, updated electrical and plumbing systems, improvements that can qualify a homeowner for meaningful premium discounts in many states, while also genuinely reducing the risk of a claim. They maintain accurate, current rebuild cost coverage rather than letting it lag behind actual construction costs. And critically, they treat their insurance renewal notice as a serious annual financial event requiring real attention, not a formality to skim and forget. The ones who get blindsided treat it exactly the way people did for decades when the market was stable, glance at the total, pay it, move on, right up until the year a non-renewal notice arrives instead of a premium. Let's close with the two scenarios. The optimistic case: reinsurance costs begin to moderate as global catastrophe modeling incorporates a few calmer storm seasons. State regulatory reforms in places like Florida and Louisiana succeed in attracting more private insurers back into these markets, and homeowners who invested in mitigation measures see meaningful premium relief as a result. Insurance costs stabilize at a new, higher baseline than a decade ago, but at least a predictable one homeowners can budget around. The realistic case: catastrophic weather events continue at an elevated pace. Construction costs remain sticky even as general inflation cools, and reinsurance markets stay tight. More private insurers continue scaling back their presence in the highest risk states, pushing more of the market onto already strained state-backed insurers of last resort, insurers whose long-term financial stability itself becomes a growing concern the more concentrated risk they're forced to absorb. Premiums in the highest risk zip codes continue climbing well above general inflation, and a growing number of homeowners in those areas face a genuine choice between paying dramatically more for coverage or accepting the real financial risk of going without it entirely. The gap between those two scenarios isn't just about premium dollars. It's about whether homeownership itself remains financially viable in a growing list of American zip codes. Here is what this actually is, once you strip away the framing of insurance as a simple annual bill. Home insurance is, functionally, a real-time pricing mechanism for climate and construction risk, updated every single renewal cycle, whether homeowners realize it or not. For most of American history, that pricing signal moved slowly enough to feel invisible. It doesn't anymore. Every premium increase, every insurer withdrawal, every homeowner quietly pushed into a state-backed plan of last resort is the market recalculating, in real dollars, exactly how risky it has become to own property in a specific location. The house itself hasn't changed. What has changed is the accumulated data on what it actually costs, on average, across millions of policyholders, to keep that specific kind of house standing through whatever the next decade brings. That number used to be quiet and predictable. In 2026, for a growing share of American homeowners, It is neither. If you want to go deeper on how insurance markets actually price risk, check out the detailed guide linked in the description and pinned in the first comment. It covers the full mechanics of how catastrophe modeling and reinsurance shape what you actually pay, far beyond what we covered here. If you found this breakdown valuable, please like the video and subscribe if you haven't already. It genuinely helps the channel grow, and there's a lot more coming.